Okay, folks. Welcome back. If you're wondering, the last class, you probably saw like 25 young kids in the class. They were a high school class from a town called Chatham where I used to live. So they come every year for one session. They have a business finance class. So if you're wondering where they showed up from, that's who they were. Now, one of these days, I plan to do a corporate finance class just for high schoolers because I don't see why not. I mean, nothing we do is that complicated. Why not? But that's for the summer. That's my project for the summer. Today, I have 3 things on my agenda. The first is I want to talk about doing an analysis entirely in equity terms. I'm going to talk about what that even means. So I'm going to start with that by looking at an iron ore project for Vale in Canada. So I'm going to focus on the equity approach. The second is, remember I said an acquisition is just a gigantic project. I'm going to bring that into process by looking at Tata Motors acquiring Harman and look at how you would treat an acquisition just like a gigantic project. In fact, if you can do the case, you can value a company because it's exactly the same mechanisms just scaled up to an entire company. And third, I want to talk about how do you pick between projects? You're saying, what are you talking about? The Disney theme park is a standalone project. It's accept or reject. But sometimes you have to choose between 2 projects because you can't pick both. So one example might be, if you have to replace your entire distribution system, you have 2 choices. Which one should I go with? So I'm going to talk about how to pick between projects. So lots on our plate. Let's get started. So let me step back and talk about what we've done so far. In the Disney theme park, when we looked at cash flows, we looked at pre-debt cash flows. You know what that means, right? I never talked about interest expenses or debt payments. I looked at cash flows before debt payments. I looked at operating income and I stopped there. I didn't subtract out interest expenses, taxable income, net income. I didn't look at any of those. So I looked at everything before debt payments and I scaled it to the entire investment in the project. I didn't ask how much came from debt, how much came from equity. But today I want to talk about what would be different if I did everything from the perspective of just the equity investors in a business. So I want you to wear blinders. You're the equity investor business. All you care about is yourself. You care about your income, which is net income, your cash flows, which are cash flows left over after debt payments, and what you have to invest in a project. So I'm going to use this iron ore mining project for Vale to illustrate this process. Lots of little details go into the project. If you miss a few, don't worry about it. I want you to focus on the big picture and what I'm doing differently here as opposed to the Disney theme park. So this project will require an initial investment of $1.25 billion. But 250 million of that is going to come from debt. The remaining 1 billion is going to come from equity. Already notice I'm telling you where the money is coming from because it does matter here. That debt is going to be repaid with a term loan. Do you know what a term loan is? There are two types of loans, balloon payment loans and term loans. In a balloon payment loan, all you pay is interest every year and you pay the entire principal at the end. So a corporate bond is a typical balloon payment loan. A term loan is what you get with a mortgage. When you get a mortgage in your house, your payments are the same every month, but some of it is interest and some of it is principal. That composition will change, but the total payment stays the same. So in a term loan, you actually pay off principal over time with your payment. So this loan, the $250 million loan, is going to be a term loan paid off over 10 years. The investment itself is going to be depreciated. And here I'm going to add a layer. It's called double declining depreciation, which basically means early on, you're going to get more depreciation and later you're going to get less. This is a choice that's been taken out of the hands of US companies now because the IRS tells you what the depreciation schedule is. But in the old days, you could pick double declining depreciation. So the salvage value will be 250 million at the end of 10 years because it's a mine you're going to eat through. You're saying, why can't we go forever? There's not enough resources to keep going forever. Yes.
When would there be advantages for you to take on one type of loan versus another?
Well, I think it depends on what's available. So banks usually don't give balloon payment loans. So if you go to a bank, you're almost always going to end up with a term loan. So first, it's a question of choices. Second, you might decide that you want to pay off the principal in pieces and end up with more equity towards the end as a project in that. So it really is a question of choices. There's nothing inherently better about one versus the other. One creates more of a change in your debt over time because your debt principal changes over time. So it's really a question of choices. The companies that end up using term loans often don't have a choice. They can use only term loans because there's nothing else available to them. So in your house, you cannot ask the bank for a balloon payment loan. No bank is ever going to say, okay, you can pay the entire principal at the end of 30 years because the structure of mortgage lending has been built on term loans. So that's the first piece. Second, this mine, once it starts producing, will have to build up over time. So there'll be 4 million tons of iron ore in year one, 6 million in year two, and 8 million tons thereafter. So for the remaining 7 years, it's going to be 8 million tons a year. The price right now is $100. It's expected to keep pace with inflation over the life of the plant. And I'm going to give you the numbers in US dollars, even though it's a Canadian plant, because commodity prices are usually in US dollars. Commodity markets are US dollar based. I could do everything in Canadian dollars. It's not going to be that different because the inflation rates are not that different, but that's the number. The variable cost of production is $45 per ton and is expected to, so as you produce more, obviously the total variable cost will go up. And there's a fixed cost of 125 million. And both these costs will grow at the inflation rate over time. So this is actually a project where all of the numbers grow at the inflation rate. The inflation rate is a US dollar inflation rate. The working capital requirements are 20% of revenues, and the investments that have to be made at the beginning of each year. So this is very similar to the Disney case where you've got to have inventory or receivables, and that's eating up cash flows. Finally, the corporate tax rate is 34%. One more thing, because this is a finite life project, at the end of 10 years, what do? I shut the mine down. I sell off whatever's left for 250 million. What do I do with all my working capital? I mean, I can't throw it out in the street. It makes no sense. If it's inventory, I'm going to sell it. So here I'm going to salvage the working capital for cost. This I did not do in the Disney case. Why not? Because the end of year 10, why don't I take the working capital back? What did I assume in year 10? That will keep going and going. If your project keeps going, you can't salvage working capital and keep it going because then you're making an internally inconsistent assumption. So the first thing I want you to focus on is because this is a finite life project, I have a salvage value at the end because I've got to tie up loose ends and I'm going to throw it out. I also don't have any capital maintenance. Why not? Because I don't keep, there's nothing, I'm not going to put money back into a mine that I'm going to close at the end of year 10. So I'm behaving consistently with my assumption. Dor?
Question about the working capital.
Yeah.
So at the end of, I understand you're kind of liquidating it for cost. Is it reasonable to assume say 50% of that just because it's a kind of a liquidation?
You could, but I'll tell you what you then have to deal with. When you sell something for below cost, you have a loss, right? If you have a loss, you have tax savings. So just to avoid the pain in the neck that comes with assuming anything other than book value, might as well just use book value and let it go, simply because it's not worth the hassle. And cost basically means you're selling it, so it'll be at 30%. So you see these discounts on liquidation. That's because your price is usually set well above cost. So cost basically assumes you're selling at a discount. It's just not at below cost. So let's look at the numbers as they flow out from these assumptions. Because I want to focus on the equity, I'm going to start off by looking at the $250 million loan I took. And I'm going to break down the payments into interest and principal. In a minute, I'm going to ask why I need to do that. Because remember, I said the total payment is going to be the same every year. It's 61.8 million every year. So if I have a total payment, you're saying, why do I care how much is interest and how much is principal each year? Why do I care how much of the payment is interest and principal from a cash flow perspective? Interest is tax deductible, principal is not. So I need to break it out to interest and principal. And notice the pattern here. This is always going to be true for term loans. Early on, the bulk of the payment is going to be interest expense. And as you go through time, the interest expense is going to decrease, the principal is going to increase. When you make a mortgage loan, the first year that you make mortgage payments, almost all of it is interest. But as you go through time, that interest portion will decrease. Why? Because interest is based on the remaining principal. So that's the amount that's tax deductible. This is going to have to come out of after-tax cash flows. So that's the first step, is figuring out what the debt payments are going to be, how much is interest, how much is principal. Let's pause before we look at the cash flows. I'm going to do my entire analysis from the perspective of equity investors. So the discount rate I need is a cost of equity, right? Second, this is an iron ore mine. So the discount rate I need is for the iron ore mining business. So if you look at the iron ore mining cost of equity, 11.13%, I'm using the dollar cost of equity because I'm going to do everything in dollar terms. So let me pause right there. If I'd done this like I'd done Disney on a pre-debt basis, looking at pre-debt cash flows in dollars, what discount rate would I use? I'd be using the 8.13% cost of capital. So if I'd done everything in pre-debt terms, from the perspective of the entire business, notice how big the difference is. So already you can see my choice of cash flows, because I'm going to look at after debt cash flows, I'm going to stay with the cost of equity. If I'd done everything in REI terms, much higher cost of equity and cost of capital in REI terms. So your choice of currency matters, and the choice of which cash flow you're discounting also affects what discount rate you end up using. So I know there are lots of numbers on this table, don't even try to read them, but here's what I tried to do. I first projected out the revenues I would get each year, allowing for both the fact that I'm going to produce more iron ore in years 1, 2, and 3. Remember, the mine goes from 4 million to 6 million to 8 million tons, as well as the fact that prices are rising at the inflation rate. So the $100 becomes 100. So as you go through 102, 104, basically that's $100 growing at 2% a year. Nothing difficult, but tedious, right? Everything is changing. We don't live in a world of nice round numbers that exists only in textbooks. The minute you start to bring inflation in, and you see this in your case, right? You get decimal points and numbers start to get messy. That's the nature of inflation. It does change your numbers because you're doing everything in nominal terms. From the revenues, I subtract out all of the costs of operations, fixed costs, variable costs, depreciation. I come up with EBIT. With Disney, I took the EBIT and I computed an after-tax EBIT and cash flows. Here, I subtract out interest expenses. Why? Because I want to get cash flows after debt payments, and interest expenses go to debt holders. I subtract it out. I get taxable income, subtract taxes, and what I get as a bottom line for earnings is net income, not operating income, because I'm looking at equity investors. Remember, I said focus on what's different, not what we're doing differently. And already you're seeing the way we measure income when you're doing everything from an equity perspective requires that you bring in interest expenses, subtract out those interest expenses, come up with taxable income and taxes. I also kept track of book value, but here I kept track of not just the book value of capital invested, but book value of equity. What does that require? Each year I computed book value of capital, just like I did for Disney, adding together the investment and the working capital. But then I subtracted out the debt outstanding because the equity is whatever's left over. This is book value of equity. I have net income, I have book value of equity. Now, in the case of Disney, after I computed after-tax operating income and invested capital, I computed a return on invested capital, right? Here, do you see where I'm going to go? I have net income and book value of equity. If I take the net income and divide by book value of equity, I end up with a return on equity. So what you do when you do equity analysis, you focus entirely on the equity investors. You look at their earnings, their book value, their return, and I compare that return on equity, 31.36%, to my cost of equity of 11.13%. And again, I'm staying internally consistent. I have a dollar return on equity compared to a dollar cost of equity for an iron ore mining project. And basically, at least based on the accounting returns, the project looks good. But a note of caution, when you have finite life projects, where you depreciate the project down, remember, you're not putting in capital maintenance, your book value will decrease over time. It's almost a given, right? Because as you depreciate, book value gets lower. You're saying, so what? Your net income builds up over time. Why? Because your project matures over time. If your net income builds up and your book value of equity decreases, look at what happens to my return equity, especially as I get to the end years. It should make you a little skeptical about average returns on equity because they will get pushed up by what you see as the return on equity in the later years. So finite life projects, it's almost natural that returns on equity of older projects are going to be higher than returns on equity of newer projects. Why? Because you've depreciated a big chunk of what's invested in these projects. Any questions on either the process of what we're doing or the mechanics of what we're doing? Now, again, a tangent, the return on capital. Remember the tangent we took? I said you can compute the return on capital for a company and compare to the cost of capital. We can do the same thing at the return equity level. I can compute a return on equity for your company. You can compute a return on equity for your company. You have a cost of equity, you can compare the two. Now, will you get the same conclusion if you're returning? I mean, remember I said return on capital is higher than the cost of capital. You generally are taking good projects. Could we make the same conclusion here? Yes, but with a caveat. Return equity is always going to be a much more volatile number because especially with highly levered companies, small changes in the company can cause huge changes in the return. If you look at the return equity of a real estate project, for instance, it can go from infinity to minus 100% overnight if the project income drops off. So as a general rule, it's, you probably should stay with the return on capital comparison. It's more stable and it tells you more about the business. Return equity can be affected by how much debt you take and can be extraordinarily up and down depending on the year you look at the company. So now I'm ready to do my cash flows. I start with net income. That's the first difference. I had depreciation. Same thing I did with the Disney theme parks, subtract capex. If I just stopped in line 4, it looks like I'm doing exactly what I did with the Disney theme park. But then you see a line item that says debt repayments. Why? Because I'm looking at equity cash flows, debt that I have to repay comes out of my cash flows. So that reduces my cash flows. Cash flows to equity are not only after interest expenses, but they're also after principal payments. Those are my incremental cash flows to equity. Could I have done this entire project to the firm? Yes, I could have done pre-debt cash flows used to cost of capital. I chose to go the equity route. And the minute I chose that, all of these things follow in terms of how I measure income and how I measure cash flows. Sorry. Yeah. So let's do the net present value. It's a finite life project. There are my cash flows to equity. There's no big terminal value. Remember, there's only salvage value. So the 667.42, the jump comes from the salvage value of the original equipment and the working capital. Do not forget the working capital. Don't leave it Because if you do, at least take a tax write-off, right? You discount them back at 11.13%, which is the dollar cost of equity. There's my net present value for the project, 304 million. So what's the conclusion? This is a good project. It adds value. It's not a huge amount of value, but you're in the mining business. You shouldn't expect to create insane amounts of value from new investments. Tells you it's a good, it's a project that if you use the same logic that we used before, should increase the value of your equity by 304 million. Any questions about, so if I just stop there and say, which of these two processes is more work? Doing an equity analysis or doing a firm analysis? What's your answer going to be? Which was more work? Equity is more work because you got to come up with debt repayments, you got to come up with interest expenses. And here's, I think, what makes it even easier to make a choice. The firm approach will actually give you a net present value that is more stable, more indicative of the project, because remember what we said about huge amounts of debt causing swings. So given that it's more reliable and it's easier to do, it seems like a slam dunk to me. You don't want to do an equity approach unless you're pushed to the wall. I'll tell you when you might end up using an equity approach. You're a private equity investor. You got clients who want to know what their internal rate of return is going to be. Remember, their internal rate of return is in terms of what equity they invest, not in terms of the firm. You might have no choice but to do everything in equity terms. So I want you to be comfortable with being able to do this because it's not rocket science. But you should not do it if you have a choice. If you have a choice, stay with what we did with the Disney approach because it's both more straightforward and more reliable. So if I wanted to know IRR, I do exactly what I did with the Disney theme park. I do a net present value profile, and there's my internal rate of return. The IRR for this project, 17.17% at that discount rate. My net present value is 0, and that's higher than my cost of equity. And you can see with both the Disney theme park and this project, if the net present value is positive, the IRR is usually higher than your discount rate. Both approaches yield the same conclusion. And with most standalone projects, that's going to be the case. So don't angst about which approach should I use, NPV or IRR. If it's a standalone project, pick one, carry it through. It's only when you choose between projects that this can become an issue as to which approach you want to pick. Yes.
What does it mean when you say like a project has only one NPV?
First, let's take the one NPV. How do you get NPV? We take the cash flows, we discount back at a discount rate, we come up. You can only come up with a unique number, right? You can't come up with two different numbers unless you screw up on which button you hit. What's the IRR? It's what discount rate gives me a net present value of 0. In a little while later in this class, I'm going to show you a project where you can have two different discount rates that both give you a net present value of 0. Now, see this net present value profile? Here it's always downward sloping. What if you have a U-shaped profile? And I'll talk about the kinds of project you can have that. It'll actually cross the line twice. You can have an IRR 10% and an IRR 35%. And you're kind of saying, which one should I pick? One is lower than my discount rate, the other is higher. I'll give you a very simple route to follow. But we're going to talk about the types of projects where it happens. And it's a purely mathematical effect. Because the IRR is a root to an equation. That's a way to think about it. And there are certain kinds of equations. You can get two roots. And if you have two roots, you have two IRRs. You can have 5 roots, 5 IRRs. And we'll talk about what causes multiple internal rates of return. Now, this entire analysis was done in US dollar terms, right? Could I have done this entire analysis in real terms? What would that mean? In this project would actually be very simple. Why? Every number is growing at the inflation rate. So in real terms, you know what the cost, the price per ton of iron ore will be, right? It'll stay at 100. In real terms, your variable cost will stay at $45 a ton, and your fixed cost will stay where they are. Your real cash flows will be lower or higher than your nominal cash flows? They'll be lower because I don't bring in the inflation effect, less. But when I discount those cash flows, what should I use as my discount rate? I used 11.13% cost of equity, which is a nominal dollar cost of equity. when I discounted my cash flows before. If I've gone to real cash flows, what discount rate should I use? A lower number or a higher? And how would I come up with the real cost of equity? What would I need to do? Subtract the same 2% inflation. So it'll be roughly 9. So if your inflation rate is 2%, instead of using 11.13%, I'm going to be using a 9.13%. So I take 2% out of my cash flows every year. I take 2% out of the discount rate. Guess what my net present value is going to look like after I've done this? It's going to stay exactly the same. The same 2% effect is being, and that's why, again, making a choice between real and nominal shouldn't be a game breaker. You want to do everything in real terms? I'm okay with that, as long as you use real discount rates and real cash flows and make sure they're consistently matched. So let's start this off. It's an iron ore mining project, and this graph should not come as a surprise. It looks like a good project, but it's based on iron ore prices today. But could iron ore prices change a lot? It's a commodity, right? It could go up, it could go down. And in this graph, I've just looked at what will happen to the net present value as iron ore prices change. So there's my base case, 100. If iron ore prices drop to 90, my net present value goes towards 0. It's pretty close to 0. And if iron ore prices go down below $90, my net present value turns negative. So I'm going to state the obvious. If iron ore prices drop a lot, you will live to regret this project. If iron ore prices go up a lot, and you could say this about any commodity project, right? So file that away. So this project's net present value is a function of what will happen to iron ore prices. It's also a function of what will happen to exchange rates. Remember, I did everything in US dollars, but this is a Canadian mine. If the Canadian dollar becomes weaker against the US dollar, the net present value of the project will go up. Why is that? Because your revenues are all in US dollars, but your costs are in Canadian dollars. If the Canadian dollar gets weaker, you're actually going to have lower costs in US dollar terms. This is why when you're a US company with foreign operations, you can sometimes benefit when the dollar gets stronger because you have lower costs. You can also be hurt by it, but you can have because you have lower costs. And if the Canadian dollar gets stronger, the net present value, it needs to get a lot stronger. It has to be about 18% stronger for your net present value to turn negative. What I'm trying to say is this is a project where you're not worried as much about micro stuff. And the Disney theme park is worried about how many people will come to the theme park? What are my costs going to look like? Here, my concerns are macro concerns. What will happen to iron ore prices? What will happen to exchange rates? And there's something you can do about both, right? If you're a company and this is what you're worried about, can you hedge against iron ore prices changing? Yeah, and all companies can hedge against oil prices changing. But should you? If you're an iron ore mining company, should you be hedging against iron ore price? Because you have to buy futures basically and lock in the price. Should you be hedging? Tell me why not? Because it seems like
part of the risk of the business. You are in that business because you want to deal with the risk.
Is it you that wants to deal with the risk, or your investors want to deal with the risk? In other words, when you think about why you invest in an oil company, you invest in an oil company because you have a view on oil prices, right? Think of how pissed off you're going to feel if your oil price view comes into fruition. So oil prices go up, but your company has gone out and hedged against oil prices. You're going to probably fire the management of the company. It's exactly what happened at Barrick Gold about 25 years ago. They went and hedged against gold prices, and they were a gold mining company, and gold prices went up a lot. And guess what their earnings did? Absolutely nothing. And their stock price stayed stagnant. And investors said, why did you do that? So if your output variable has risk, it probably doesn't make sense to hedge that risk, even though you will sleep better at night as a manager of the company, because your investors want to be exposed to that risk.
But in general, doesn't your discount rate account for the risk of whatever's going to happen here?
You can, I mean, but in a sense, gold price risk is not showing up, or oil, because it's not lowering your discount rate, right? Because to the extent, remember we talked about what drives betas. Commodity price risk doesn't show up in betas because it's diversifiable risk. So if I'm buying an oil company, I'm also buying other companies. So you're reducing a risk exposure that doesn't affect me at the portfolio level. But here, what's good for managers and what's good for the investors cut in opposite directions. This is what risk management product people recognize. So when they come and sell you hedging against iron ore price risk, guess what they offer you as the reason? They say your earnings will become more stable. You can sleep better at night as managers. Go out and buy that hedge. But essentially at the same time, your investors are saying, that's not good for me. It's not giving me any benefits. But this is a classic case where corporate governance can probably lead to too much risk management, too much hedging, because what's good for managers and what's good for investors doesn't converge.
In the case of the airlines,
Yeah.
where you said that Southwest had a.
That's an input cost. When you have input costs and you're hedging, you're doing it presumably for operating reasons. You know what Southwest, historically what Southwest claimed to fame has been, their prices are more predictable. It's not like United, where 1 week you check and it's $700 and the next week it's $400. Historically, Southwest has sold a more predictable price stream. It doesn't offer discounts. And the way they can do that is they know what their costs are going to look like. And the way they know it is because they've hedged an input cost. If you're Hershey's and you can't afford to see a chocolate price jump up and down, it makes sense for you to hedge against both cocoa price risk and sugar price risk because it's in. So I have more patience for companies hedging against input costs being variable because it's an operating reason for it. But output costs, that's why you're in business. You shouldn't be hedging a risk that your investors are seeking out. And that's the big difference between output and input cost hedging. Even the input cost hedging, you can go overboard and say, why are you hedging that risk? Let it flow through. But at least with input costs, you have a basis for saying, it makes me better as an operating company to know what my cost structure looks like. Now, in exchange rates, exchange rate is the most hedged risk in the world. If you look at all the risks that are macro risks that are hedged, exchange rate risk is the most hedged because it's also the most accessible risk. You can buy, hedges against the dollar, euro, dollar, yen, dollar, pretty much even emerging market currencies. Should you hedge exchange rate risk? It's not the slam dunk you had with either sugar prices for Hershey's or, oil prices for an oil company. Oh, let me rephrase the question. What has to be true about your investor base for you to be hedging exchange rate risk? What kind of company should you be? US doesn't quite do it. It depends on whether your investor base is a global investor base. If your biggest investors are Fidelity and BlackRock, you should not hedge exchange rate risk. You know why? Because they have investments across the world, and they're going to see this exchange rate risk being diversified across their own portfolio. And they don't want individual companies going out and spending money, covering a cost that's going to disappear at their portfolio level. So if you're a large market cap company, a company like Disney, you should probably not be hedging exchange rate risk. If you're a small Midwestern company that's insider held and most of your investors are domestic investors, then I think you have a better case for hedging exchange rate risk by saying, my investors don't have these international portfolios. And even there, you got to test and make sure that that is true before you go out and hedge exchange rate risk. So when you look at these risks, you really have to think through what the benefits are and who the benefits accrue to, and whether in fact you're spending something that doesn't provide benefits to your investors. And even on exchange rates, the Canadian dollar, don't even waste your money hedging against risk. It doesn't mean it's not volatile, but it's not going to double or half. If this is the Brazilian real that you're doing it, maybe again you have a better case. Why? Because you want to avoid that catastrophic risk that can come from a huge movement in exchange rates. You don't want to put your company at risk by taking a Brazilian project that looks good, but then have a 50% devaluation in the real and have your project blow up and take your company down. So hedging, should you hedge, is one of those fundamental questions that every business faces. The answer is actually tricky. And I don't know whether this flow chart makes sense, but let me go through the flow chart. So I come to you and say, so let's suppose you ask me a question, should I hedge a risk? My first answer is going to be, is there a way you can hedge this risk costlessly? You're saying that's too good to be true. I'll give you an example. If you start a retail business, one of the risks you run is location risk. You know what location risk is? You pick Bleecker Street because you see a lot of people walking up and down the street. But then New York City shuts off Bleecker Street. There goes your business, right? Every retail business always worries about location risk. But if you're a big retail company, how do you hedge that risk? You just open stores in different parts of the country. Location risk kind of averages out because some locations will do better than expected, some will do worse than expected. That's effortless hedging. A lot of hedging happens in the course of operations. This is why a big retail firm has far less location risk than a much smaller localized retail firm. So if you can hedge risklessly, why are we even talking about it? Just go out and hedge the risk. But if there's a cost, I'm going to ask you, what is the benefit from hedging? You talked about lower discount rates, and you have to talk about what kind of risk do I need to be hedging for discount rates to be lower? It's got to be some kind of macro risk, right? Interest rate risk, inflation risk. Maybe you're doing that, in which case I can give you a benefit of a lower discount rate. You still have to work out whether the benefits of that lower discount rate are greater than the cost, but at least we're talking about something that potentially could give you benefits. It could also presumably also show up in your cash flows. You're saying, how can hedging a risk show up in my cash flows? Maybe hedging a risk can help you be more focused as a manager in picking projects. This sounds like, that should be a you problem if you're a manager, but let's face it, managers' you problems become investors' our problems. So if you're developing ulcers because exchange rates keep moving on you and taking bad investments, maybe by hedging this risk, you will manage the company better. But in every case, the question you got to always ask is this cheaper for my investors to do than for me? And that's why with exchange rate risk, with many large companies, the answer is it's cheaper for investors to do this, because if you're a portfolio and you have 100 companies, think of the exchange rate risk you face across 100 companies. It's always going to be lower than the exchange rates individually added up across 100 companies. It's a very difficult question to ask, right? Managers think about the company, they think about themselves. Every person selling risk management products talks about the company and what the risk of the company will look like. Very few people bring in that perspective of my investors are not just in this company, they have a portfolio. They're diversified, and I have to think about risk through their eyes. So I would suggest you pick any risk you're concerned about and ask, is this a kind of risk I should be hedging? Because remember, insurance is a kind of hedging as well. Right? Ask yourself, why do we insure some things and not insure others? And if you're a business, you can look at the effects in terms of what do my investors get out of this? Yes.
You see a trend in in the consolidation of passive investors, which is like large funds like BlackRock, Vanguard, etc. You see a decrease in hedge during the year.
I'm going to say this, and this is something I'm going to come back to in both dividend policy. The two strongest forces in corporate finance are Me Tooism and inertia. What's Me Tooism? Companies do what everybody else does. Inertia is they do what they've always done. It's kind of an indirect answer to your question. There's very little change in this practice over time. Why? Because if you started hedging in 1974, you're still hedging. It's a strange phenomenon. It doesn't reflect the changing investor base, but I think you're making a good point. Maybe there should be a lot less hedging today, given that your biggest investors are index funds, which have thousands of companies in their portfolio. But we're not seeing that massive drop off because you have an entire ecosystem out there trying to sell protection. You got to figure out how much force they can have. I mean, I've seen the spreadsheets that bankers come up with. They show earnings without hedging, earnings with hedging. Look how much more stable. And implicitly, what's the implication they draw? If your earnings are more stable, you should have a lower cost of capital, which is absolutely not true, because much of that variability in earnings you're removing is variability in earnings that's specific to the company that investors who are diversified could have eliminated on their own. So any other questions on hedging? So now let's talk about why an acquisition is a project and what you will do differently or the same in an acquisition. So if you think about the rules for a traditional project, you should have a positive net present value for you to accept it, right? Same rules apply in acquisition. For an acquisition to create value, it has to have a positive net present value. Which if you take the cash flows from the acquisition, you take the present value of those cash flows, it should exceed what you pay. But there is a glitch in the acquisition process that you have to deal with separately, which is synergy. What is synergy? When you bring two companies together, you might be able to do things you could not have done as standalone companies. Let me repeat that again. Synergy is two companies coming together that are able to do things they could not have done as standalone companies. You're saying, what is that synergy? Well, synergy creates cash flows as well. So when you do an acquisition, you first value the target company, you come up with the value. It might be lower than the price you're paying, but if you have enough synergy to cover the difference, I'm all for the acquisition because your overall net present value is positive. So let's look at how we go about the acquisition process. And I'm going to start by just focusing on the non-synergy effects, valuing the target company. And when you value a target company, here's the first rule. Look at the cash flows to the target company because that's a cash flow and discount it back at a rate that reflects the risk in those cash flows. Let me repeat that again. If cash flows in a target company, you want to discount them back at the risk that that's in the cash flows that you're discounting. There are two companies involved here, right? There's an acquiring company, there's a target company. The acquiring company has a cost of capital and a hurdle rate, and target company has a cost of capital and a hurdle rate. Given what I just said, when I discount the cash flows of the target company, which of the two discount rates should I be using to discount? The acquiring company's cost of capital or the target company's cost of capital? It should always be the target company's cost of capital. Why? Because it reflects the risk of the target company. So if I'm a very safe company buying a very risky cloud computing company or a software company, I shouldn't be using my low cost of capital to discount those cash flows because they don't match. You know how often this principle gets violated in the M&A process? In half of all acquisitions, the acquiring company's cost of capital gets used to value target companies, and you're violating a first principle in discounting when you do that. I won't go into why that might happen because that's such a horrific mistake, but it happens all the time. So, question, Doc. Yeah.
It's just because it's so important. When you are using this cost of capital discount, the cash flows, you're basically saying, this is my cost of capital, this is my required.
This is my required return. In fact, the problem is we call it cost of capital. When you call it cost of capital, what do you think in your mind? This is the cost of raising money. That's really not what a discount rate is.
It's to require what you require.
Exactly, given the risk of the investment. Yeah.
But it's the company acquiring that's requiring.
But it's the investors in the company. The company has no money, right? Whose money is the company using? It's the investors' money. The investors. So think of the investors looking at the target company. Take the acquiring company out of the middle. If the investors had been looking at the target company, how would we have come up with the cost of capital? The investors.
It's the investors.
But what do the investors base it on? They look at the risk of the target company. So basically we make the argument that the risk is measured by the risk you can't diversify away. The investors looking at the target company to come up with a beta that reflected the risk of the target company, a debt ratio that reflected how much it could borrow, a cost of debt that reflects its default risk. So the fact that you put an acquiring company in the middle doesn't change any of those dynamics. So if the logic is I want to use a discount rate that reflects the cash flows of what I'm discounting, it should always be target company focused. So the fact that you as an acquiring company can borrow money at a really low rate is completely irrelevant, right? You don't want to subsidize an acquisition by the fact that you have really low cost of debt. People do it all the time, but you don't want to end up overpaying for all the wrong reasons. And this is one of those wrong reasons.
So they have apply also for projects. You should see the cost of capital.
That's exactly why we used 11.13% for the iron ore mining business when we discounted the iron ore mine cash flows. That's why we used the theme park cost of capital to discount the Disney theme parks, right? It's the extension of the same principle into acquisitions. So here are the two companies. Tata Motors is the acquiring company. It's an Indian company. Harman Audio is the target company. It's a US company. So I want you to keep your eyes on Harman Audio because this is really about Harman Audio. So here's the first step. let's estimate the cost of capital. And we're going to do everything in US dollars. Why? Because it's more convenient. Cash flows are going to be in dollars. It's a US company. So my risk-free rate is going to be the USD bond rate. For the beta, I use the beta for electronics companies. Why? Because the company I'm acquiring I can't use an automobile beta. It doesn't make any sense. It's an electronics beta, 1.17. The equity risk premium that I came up with was the equity risk premium based on where Harman gets its revenues. And finally, for the debt ratio and the cost of debt, I'm going to assume that Harman's existing debt ratio reflects what they can borrow, and their cost of debt reflects what they can borrow at. So the overall cost of capital that you see here would have been the cost of capital I'd have computed for Harman Audio if this acquisition were not even in the picture. So if Harman Audio had called me and said, what's my cost of capital? My cost of capital would be 9.67%. My suggestion is anytime you have an acquisition, go through that exercise of estimating the cost of capital of the target company. And if you see a cost of capital being used that's very different from that number, push back. So where is that difference coming from? Because usually it's coming from all the wrong places. So 9.67% is going to be my cost of capital. For the cash flows, let's keep things simple. In the most recent year, Harman Audio had $201 million in operating income. No, but they had a non-recurring charge of 83 million. So if you adjust for all the one-time and the non-recurring, their operating income was about 313 million. So I'm cleaning up the operating income just to make sure that I'm getting a sustainable operating income. They paid 18.21% of their income in taxes, and at least for the near term, I'm going to assume that they can keep their tax rate at 18.2%. Unlike the cost of debt, we always have to go with the marginal tax rate. When you do cash flows, you have to allow for the fact that companies might be able to keep their taxes low. For the reinvestment, they had depreciation of 128.2 million. So I'm doing what I did with the project, but on a much bigger scale, so the entire company. There's a depreciation for the entire company. Their CapEx was 206 million. Their working capital was 272.6 million during 2013, but it's about 13.5% of revenues each year. What I'm going to do is compute the pre-debt after-tax cash flows for this company using the aggregated numbers. Okay. I'm going to keep things simple because I don't want to end up in a valuation exercise and assume that Harman Audio is a mature company standing alone. Now, there might be synergy benefits that I'm not bringing in yet, but it's a mature, stable growth company, 2.75% a year. And they're my expected cash flows for next year, if I allow for that growth rate of 166.85 million. So my operating income grows at 2.75%. The depreciation, the CapEx, and change in working capital reflect that growth rate, 166.85 million. You're saying, why is my working capital dropping by so much? Because I'm computing it as a percentage of the revenues rather than looking at the most recent year's change. Changes in working capital can jump around a great deal. So that's why using a percent of revenues gives you a smoothing of the process. So if I were to value Harman Audio, a lot of moving parts here. I take the 166.85 million expected cash flow next year. There's my cost of capital for Harman Audio, 9.67%, growth rate in perpetuity. My value for the company is 2,476 million. That cash, you subtract our debt, the value for the equity is about 2.7 million. So if I didn't even know there was an acquisition on the horizon, if I were to value Harman Audio as a standalone company, the value that I get is 2.7 billion. The market cap was 5.4 billion. Already you can see the dice are loaded against this acquisition, right? If I go pay the 5.4 billion, I'm paying double my intrinsic value. Could I justify it? What's the only way you could justify it is by showing there's enough synergy here to cover that difference. I haven't dealt with the synergy yet. Later in this class, I will come back and value just the synergy, and it's going to be well below 2.7 billion. Which means if this is an acquisition they're considering from a value additive standpoint, I would say don't do it. There's not enough intrinsic value here to justify even the prevailing market cap. You need an insane amount of synergy to get there. But if this is an actual deal, my guess is once it gets legs, it'll keep going. Because there are too many people invested in the process and getting the deal done. And the definition of success in a deal is getting the deal done, not getting a good deal done. So you don't want the process to get started if you don't think it'll lead to an end game that actually creates value. So the one thing is that, I mean, I know that there are a lot of acquisition numbers here that we're not quite comfortable with because we haven't valued companies. But I want you to focus on the rule that you take out of this, which is the discount rate should reflect the risk of the cash flows, not the risk of the acquirer looking at the cash flows. And that's a principle I want you to always follow. This morning, I got an email from somebody, some North African company, and it's a 25-year, it's an infrastructure company. It's a single project company. Their contracts were with the government, and the government basically has guaranteed the cash flows the next 25 years. And they're saying, which cost of equity in your table can we use? And my response was, why are you looking at a cost of equity? You see what? The cash flows are guaranteed cash flows. They're guaranteed by the Egyptian government. So you got to take that guarantee with a grain of salt. The cost, the discount rate you should be using on this should be really a cost of debt with sovereign default risk built in there. It's a very simple principle. It's actually a very powerful one. It tells you what discount rate you apply on a set of cash flows to always reflect the risk of the cash flows. So don't get caught up in, I want to get a beta for a business and do it automatically because it depends on what your discount with that rate. Any questions about, so we looked at the Disney theme park. We very briefly looked at a Disney streaming project. We looked at an iron ore mining project, and we've looked at an acquisition. So if you get a chance, set them side to side. No, presumably after you've turned in your case and you have, it's less on it, because it'll give you a sense of, what's different in each case and what's similar. You'll notice that the commonalities actually vastly exceed the differences because we're trying to do fundamentally the same thing in all four cases. Now let's talk about what if you don't have a standalone project? What if you have to make choices? Some cases you have no alternative but to choose one over the other. Why? Because you're replacing the flooring in your kitchen. And I come to you with three choices ranging from cheap to expensive, but the cheapest flooring will last 5 years and the most expensive flooring will last 30 years. You can't pick all three, or you'd be crazy to pick all three because you can pick only one of those. So mutually exclusive means if you pick one, you cannot pick the other. In some cases, if you're a small company with limited cash capital, even standalone projects can become mutually exclusive. Do you see why? Because if you take one project, you cannot take another. You don't have enough money to do it. So I want to talk about comparing projects. And I'm going to start with the simpler case, which is projects which have the same life. So picking between 2, 10, you see why having different lives on projects can make an issue. But starting with projects with the same life. And let's make them mutually exclusive. You pick project A or project B. Which one can I pick? Or should I pick? So the two time-weighted incremental cash flow approaches we came up with were NPV and IRR. When we had standalone projects, I said, don't make a big deal. They're probably going to give you the same answer. If one says good project, the other one's also going to say good project. But if you're picking between two projects, you can sometimes get different answers. I'm not going to spend a vast amount of time on this because I think it's very intuitive as to why they give you different answers. But let's look at the three cases where you can end up with different answers. So if you have a project with the same life, you take a net present value of each project, you take the IRR of each project. You pick on a if you're doing net present value, you pick the project with a higher net present value. It's IRR, you pick the project with a higher IRR. I'm going to offer you three cases where I'm going to take two projects. I'm going to compute the NPV and IRR, and the two approaches are going to give you different choices. NPV is going to say, take project A. IRR is going to say, take project B, or vice versa. I want you to think about what it is about the two approaches that are leading you to different conclusions. So here's the first one. Two very simple projects. They're both 4-year projects. There's project 1, there's project 2. Project 1 requires $1 billion investment upfront. You make 800 million in year 1, $1 billion in year 2, $1.3 billion in year 3, and in year 4, maybe there's a back-ended license fee. You got to pay out 2.2 billion. So you got a negative cash flow in year 4. Project 2 is a much more conventional project. Conventional project, you invest upfront and you get positive cash flows thereafter. You can compute the NPVs of both projects. You're going to get a single NPV, each project. Why? Because NPVs are unique. But let's see what happens when you compute the IRR for the two projects. For project 1, project two, the IRR is about 11%. There's only one IRR. It looks very much like the Disney theme park. But in project one, there are two internal rates of return. Notice there are 2 points at which it crosses. One is at about 36%. The other is around 6%. That's a big difference, right? Before we look at which of those IRRs you should use, why are there two internal rates of return in project one? What is it about project one that gave you two internal rates of return? You had two sign changes. I know this sounds incredibly and insanely mathematical. You get negative to positive and positive to negative. Let me make a mathematical statement. Every time there's a sign change in your cash flows, there's an additional root to the equation. Thank God we're not mathematicians and we have to dig too deeply here. So you have two sign changes, you're going to have two IRRs. If you have three sign changes, you have three IRRs. You have five sign changes, you have five internal rates of return. You say, what kind of project would have that many sign changes? Let's say you take a 30-year project, but every 5 years, you got to make a reinvestment to keep the project going. So odds are you're going to have positive cash flows in years 2, 3, 4, and then year 5, you're going to have negative. Year 10, you're going to have negative. Year 15, you're going to have negative. Potentially, you could have 6 internal rates of return for one project. What do I do? I'm going to give you a very simple answer. When you have more than one IRR, use the net present value. You know, I've seen entire books written about what should we do. None of them make sense to me. Because you can do all these mathematical, you can move the negative cash flow back to the first year, make it look like you had only one big, but you're playing games. If you have more than one internal rate of return, the internal rate of return becomes unusable. There's always only one net present value. Just go with the net present value. So the first choice, what if I have, if a case where you have two IRRs and one NPV, just go with the NPV, ignore the IRR completely. Let's take a second case, and this is, I think, a trickier, more interesting case. And so this, so if you have more than one IRR, just go with the NPV. Here's the second case. You have two projects, they're both 4-year projects. But the first project requires only $1 billion to invest. The second project has a $10 billion upfront investment. The cash flows, I've computed the NPVs of the two projects. I've also computed the internal rates of returns of the two projects. Project A has a lower NPV than Project B, but Project A has a higher internal rate of return than Project B. This is a very intuitive reason why. Why is the NPV for Project B much higher than NPV for Project A? It's a much bigger project. NPV is going to be skewed towards bigger projects. So if you are using NPV as your decision rule, you're going to pick bigger projects over smaller projects. We'll come back and ask, is that a good thing or a bad thing in a minute? But NPV is going to skew towards bigger projects. IRR as a percentage rate of return is going to skew you towards smaller projects. You open up most traditional corporate finance textbooks. They look at NPV and IRR. And they make a categorical statement. NPV is actually a better rule because it follows the rules of finance better. And it's true. But implicitly also, the reason they suggest you should use NPV is we said NPV measures how much value is added to the company. Obviously, the second project adds more value than the first one. But it also sucks up more capital. And in traditional corporate finance, the assumption is you have unlimited capital access. If you have unlimited capital access, you should always go with NPV. Even though it's going to skew you towards bigger projects, so what? You can keep taking projects as you go along. So if you pick Project A, it gives you a much higher percentage rate of return, but Project B adds more value. And if you're a company which has no capital rationing constraints, you should always go with NPV. But if you're a smaller company of capital rationing constraints, I can make a case that IRR is better for you than NPV because it gives you a much bigger rate of return on the limited capital you have to pay. So again, if you expand this out and say, what kinds of companies should use NPV and what kinds of companies should use IRR? If you Google or Apple, you should never even be looking at IRR. Why are you wasting your time? You got a $150 billion cash balance. You shouldn't be asking, where will I get a 35% return? You should be looking to see how much you can make as additional NPV. But if you're a snowflake, small tech company, you're dependent on capital coming in to keep growing. You want to get the most bang for your buck. I think you can make a legitimate case that internal rate of return is better for you. So I don't buy into this notion in traditional books that NPV is always better than IRR, because it depends on how much of a capital rationing constraint you face. Yes, Don.
Is there no reason behind saying the IRR makes you more like, because it's a small project makes you more diversified in terms of projects?
That's a dangerous argument, right? Because then I'm going to ask you who your investors are. And here's the risk though. If you take the smaller project because it gives you a higher IRR, what's your worst case scenario? What's your nightmare scenario? Not that it loses, but that no other projects show up, right? So let's say it's January 15th. You took the small project. We'll have 9 more projects over the year. What's the big deal? If those 9 projects don't show up, if you have the cash, it's going to sit there and not be invested. So if you have lots of projects and you have lots of cash, just go for the NPV, because there you don't know. So with IRR, the worry often is I'm going with smaller projects, but I'm turning away this opportunity, take a much larger project and get a much higher net present value. Will I live to regret it? And sometimes the answer is yes. Whereas if you go with NPV, the regret is the opposite, right? If you have limited capital, let's say you have exactly 10 million in capital, you take the second project. And then another great project comes along in June or July. You can't take it now. So the things you regret are going to be different in each case. With capital rationing, you'd much rather have, I have the first regret rather than the second one, because you don't want to tie up all your capital in a big project and not be able to take smaller projects.
But let's say your capital is unlimited, like you said.
Then
right?
go with the NPV.
Unlimited capital, and let's say you have a bunch of projects
Right.
to pick from, 50 projects, right? You need to pick either 10 of them for 1 million or 1 for 10 million, right? Which one would you pick?
And they both have, the collective net, so they're mutually exclusive, but the mutual exclusivity between taking 10 million, then I'd add up the net present value of the 10 mini projects and see if it's still an NPV, right? It's not an IRR that's leading me there. It's because a collective NPV across the 10 projects is greater than the single project. So you have no capital rationing, always go with NPV. If you have capital rationing, then percentage rates of return make sense. So capital rationing is the ingredient here, the magic ingredient. And already you can see why, if you're an emerging market, you're probably better off focusing on IRR than NPV, because you might say, look, I've limited capital. I want to get the most bang for my buck. I have to get the highest percentage return. Whereas if you're in a developed market, access to capital, you're a big, large market cap company, then NPV makes more sense to you, because you're saying, look, my concern is I don't have enough projects. I want to get them, I would take the best projects I can, the projects that add the most value. It tilts you towards larger projects, and it should if you have no capital rationing constraint. Any questions on NPV versus IRR? There's a scaling issue. So that's basically what you see play out. IRR is going to skew you, bias you towards smaller projects, and that's not a bad thing if you have limited capital. NPV will bias or skew you towards bigger projects, and that's not a bad thing if you're a big company with access to capital. And in fact, private to public, you should see many private companies that used to use IRR switch to NPV as they age and grow through the life cycle. They don't always do it because of the inertia in the process. They get stuck to earning 35% IRRs. They turn away projects that make 28% internal rates of return because they're not good enough. You're in a terrible position because your cash builds up. You don't get, so you got to live in the kind of company you're running rather than the kind of company you used to be 5, 10, 15 years ago.
Sure.
Yep.
In any private equity fund, when they give you an IRR, which IRR are they giving? And you have double.
Which one do you think they're going to
The
take?
highest, but
In fact, I won't even blame them, because most of them don't do a profile, right? How do they come up with an IRR? They use the IRR function in Excel, and it did a very sneaky thing until recently. Now, you know what IRR used to make it, the IRR function in Excel used to ask you to do, right? Because it can't deal with multiple, it would ask you to guess what your starting IRR is and give you the internal rate of return that was closest to that guess. Now, do you see why I don't trust the IRR function in Excel? But take that and try this as an exercise. Take your Excel, put the cash flows I gave you for project 1. We have that negative cash flow. Put the IRR function, see what you get as an answer. because it'll give you a unique answer, even though it's not a unique answer. And that's going to give you some insight into what you end up seeing. Now, I have a bigger problem with private equity IRRs that goes beyond the multiple IRR. But I'll come back to that in the next comparison. But if they're going to pick one, they're always going to pick the higher one. Now, if you want to stay with NPV, there are other assumptions that IRR makes that might make you uncomfortable. There's a way in which you can deal with capital rationing within an NPV universe. What's the problem with NPV? It gives you a dollar value, right? It doesn't look at what you invested up front. So here's something you can do as a simplistic fix to NPV. You take the NPV and you divide by the initial investment you made for a project. You come up with what's called a profitability index. It's called a PI. So take the two projects I had. The first project, an NPV of 467,000, second project, 1,358. You divide by the initial investment, you come up with almost like a percent NPV. And now you have a capital rationing constraint. Rather than go with the IRR, you could stick with NPV, but go with the profitability index and say, I'm going to pick project A over project B because I'm getting a higher net present value for every dollar invested. So it's kind of a middle solution for people who don't like IRRs because of the other assumptions it makes and who like NPV but have a capital rationing constraint. This is actually an intermediate solution. Which brings me to the third case. And this is something I already mentioned last session, but let's see if you remember what that factor was. I have two projects which have the same scale, so you can't blame scale here. Different pattern of cash flows. First project is higher cash flows upfront, lower later, lower cash flows upfront, higher later. They're both time value, time weighted cash flow returns. But here's the strange thing. The second project has a higher net present value than the first one, but the first project has a higher IRR. What is it in this case that's leading to different rankings for the project? What am I assuming that's causing this, you think? But remember, IRR don't even have a discount rate. So, I'm sorry, what?
How far they close.
But finish that thought. They both are time weighted, so they both are factoring that in. They must be factoring them in differently. Do you remember that reinvestment rate assumption that I talked about? What does IRR assume? That the 5 million that I get in year one gets reinvested at the IRR. The NPV approach assumes that 5 million that I get in year one gets reinvested at my cost of capital or my discount rate. It's a reinvestment rate assumption that's leading me to a different choice. And here, my clear preference is with NPV. And here's why. When I take an IRR of 21.4%, and I assume that I can reinvest my money coming in year 1, 2, and 3, that's a pretty dangerous assumption. Because not only am I assuming that this project is good, but that I have other projects just like it. And this is where I have an issue with private equity IRRs. They give you a 10-year project. They give you a 45% IRR. You know the question you should be asking, right? Even if all those numbers are right, the question you should be asking is, where are all those other projects in year 1, year 2, year 3, year 4, year 5 that I'm going to invest in at 45%? Because if you don't invest at 45% and you look at your ending number, you're not going to earn 45% IRRs, even if the cash flows came in exactly as predicted. It's IRR's weakest link, this reinvestment assumption. And by reinvesting at the IRR, I'm essentially overstating the goodness of my good projects. Right? Because I'm not saying the project is a bad project, but I'm overstating the goodness by assuming that there are other projects just like it out there. Whereas NPV assumes you reinvest at the discount rate. And how do we come up with discount rates? By looking at what you can make on similar investments in the market, right? Risk premiums, risk-free rates, almost by definition, if you've computed cost of capital right, those opportunities should exist out there. So it's a much more reasonable assumption. Is there a way I can fix the IRR assumption? Now, basically, you're making different reinvestment assumptions, and clearly, the NPV assumption is more reasonable that you're reinvesting at the cost of capital or cost of equity. Is there a way I can let's say I'm really attached to IRRs, just like the previous case, people really attached to NPV and I gave a PI or a profitability index. Let's say you're really attached to IRRs and private equity investors are. Is there a way I can fix IRR with this reinvestment assumption? What's my problem? I'm taking my intermediate cash flows and reinvesting them at the internal rate of return, right? So what if I could take the IRR rule and modify it? So the IRR rule standing alone makes this unrealistic assumption about reinvestment. What if I could fix that assumption? I know it sounds abstract, but it's called a modified internal rate of return. Here's what I'm going to do. I have a project, initial investment is 1,000. There are my cash flows. If I do a traditional IRR, I get 24.89%. What am I assuming? The $300 million in year one gets reinvested 24.89%. The 400 million in year two gets reinvested 24.89%. Let's say my actual discount rate is 15%. I can actually take the 300 million in year one, invest it at 15%. Take the so basically I'm looking at what I will end up with at the end of year four if I take each of the intermediate cash flows and reinvest them at the discount rate rather than at the IRR. If I take the end value here, which is 2160, and my initial investment, and I back out an IRR, I come up with an IRR of 21.23%. You say, what happened? How do I lose 3.67%? That's how much additional return you are putting in because you could reinvest at the internal rate of return. Yes.
I have a question. When we had the problem with the two IRRs because there were
Right.
negative changes, what happens if we do the inverse? Those negative cash flows in the future, if we bring them to the present?
That's one approach dealing with multiple IRRs is to actually make all the negatives, consolidate them up front and come up with an IRR based on that. Then you'll get one IRR. But it's a little artificial because what discount rate you apply to that, you probably have to use a modified IRR approach to do the discounting rather than the traditional IRR. It adds a layer of complexity, but that's one fix to the multiple IRRs. It's to consolidate all the negative cash flows into one upfront investment by taking the present value of those investments. So is everybody clear on the modified IRR? So rather than reinvest at the IRR, I'm reinvesting at the discount rate, removes the problem. And if I remove the problem, the two, go back and do the example that I did, the ranking differences will disappear. Then the modified IRR basis will give you the same ranking as the NPV if I have projects of similar scale. Any questions on NPV versus IRR? Sorry. So let's summarize here. You can have only one NPV for a project. You can have more than one IRR. So again, it's not the end of the world, but it can happen. Second, NPV is a dollar value. So it's going to bias you towards bigger projects. IRR is a percentage return to bias you towards smaller projects. I'm not saying one is better than the other, but they're different. So that's why it sometimes fits for some companies to use NPV and others to use IRR. And third, there is this implicit reinvestment assumption. And the reason it's so insidious is you don't even make it explicit. It's when did I assume that I can reinvest at the IRR? You didn't, but that was effectively what was assumed implicitly. And that reinvestment assumption can get you into trouble, especially if you have really high IRRs and very long-term projects. So when somebody gives you a 10-year project with a 40% IRR, a modified IRR could be 23 or 24% for that same project, even if you kept every single cash flow at its forecasted level. Let's extend the comparison when you have projects with different lives. Let's say I have two projects. One is a 5-year project. The second is a 10-year project. I compute the NPV and IRR of both projects. NPV of project, the second project is higher than the NPV of the first project. And the reason is simple, right? Why? It's a dollar value. So I have more cash flows. It's almost given that a 10-year project is going to be tilted to having a higher IRR than a 5-year project. So when you have projects with different lives and they're mutually exclusive, you can't compare the NPVs because you're always going to be picking the higher, longer life project because it's going to look better. We'll talk about what to do with to fix it. IRR doesn't have that issue. Why doesn't it have that issue? Because it's the percentage rate of return. So that's another reason you might use IRRs is if you're comparing projects with different lives, you're saying, I'm too tired to do NPVs. I don't want to do this over different lives. You can go with internal rates of return. But here, there's a simple fix I can use to make these projects have the same life. What's that fix?
Discount.
It's still going to take care of not bring the, it's one is a 10-year, one second is a 5-year. I picked 5 and 10 deliberately for this reason. What could I do with a 5-year project? What if I did it twice? I know this is incredibly simplistic, but 2 times 5 is 10. So if I did the first project twice, that's called basically you're replicating the project. You're assuming the same project can be done twice. Now you have two 10-year projects. And you can compare the net present values of doing the first project twice versus the second project once. Thank God I didn't give you 9 and 13-year projects, right? Because then what would you have to do to get the same life? You'd have to do 117 years for both projects and do the net present value. I'm going to give you a fix for that. But in replication, you're hoping and praying, let it be 5 and 10 or 3 and 6 or 3 and 9 because it's doable. But if you have two prime numbers, God help you, because you're going to end up projecting cash flows for 15 times project 1 and 11 times project 2 and hoping they match up. There's a second way you can deal with this. And the second way, what you do is you take a net present value, which is a lump sum number, and you convert it into an equivalent annuity. What is an equivalent annuity? You take the net present value and say, if I got an equal amount each year over the life of the project, what would it translate into? It's a very simple conversion. But then you can compare a 9-year project to a 13-year project. And instead of comparing the net present values, you compare the equivalent annuities. So let's try both. First one, I replicate it. So the replication basically means I do the first project for 5 years. At the end of year 5, I repeat the project. Now, does the cash flow have to be exactly the same for the second 5-year period? Not necessarily. You can make assumptions about inflation and what it'll do, but you do the first project twice. So now I have 10 years of cash flows with two investments. The net present value that I get is 693. Net present value project B done once is 478. These two net present values can be compared because they're over the same life. The second approach is to take the net present values, 442 million and 478 million, convert each into an annuity. If the way I've structured it looks strange, I'm taking the present value and converting an annuity using a 12% discount rate, and 5 years is my life. In calculator or or computer terms, I'm looking for the payment that will give me the same net present value over a 5-year life. So the way to read this 122.62 million is with a 12% discount rate. I'm indifferent between getting 442 million today or 122.62 million every year for the next 5 years. I take the 10-year project and convert into annuity using a 10-year life and the same 12% discount rate. I get 85 million. 123 beats 85. I'm going to pick project A over project B. Again, the right thing to do. Replication and annuities will always give you the same answer because you're making the same implicit assumptions. But annuities are a lot less work, especially when you have these strange numbers where replication might require doing things over 70 or 80 or 90 years. But with projects with different lives, you always have to be careful that you're not comparing lump sums and net present values because it's not fair. Longer term projects are always going to beat shorter term projects. But we're talking about costs. Doing something long-term will always have a higher cost. So if you're looking at replacing your heating system, and I give you a 15-year option and a 30-year option, I can almost guarantee you the 15-year option is always going to be cheaper upfront. But you convert into an annual cost, the 30-year option might be better, especially if you consider the time value of money. Okay. So annuities basically convert lump sums into annual amounts, and annual amounts can always be compared. So we talked about a lot of different ways to pick projects, right? We started with return on invested capital, ROE. I talked about payback as a way of dealing with risk. We talked about NPV. We talked about IRR. We even talked about this profitability index, NPV divided by initial investment. Each comes with its pluses and minuses. None of these is a slam dunk. We say, which is the one? I can't say which one's right for you until I know what kind of company you are. But I did give you my biases. I wanted time-weighted incremental cash flow return. I prefer NPV and IRR to accounting returns and payback. But if you're the CFO of a company or you're the CEO of a company, this is your own business, saying which decision rule should I pick? You got to think through what kind of business you are, how much capital rationing you face, what kind of projects you have, what your choices look like before you decide on a. And you can say, why can't I use all 5? You can, but you have to have a dominant approach. Which approach wins out? Which is your tiebreaker? So it's difficult to see what these numbers look like in practice, but I have three numbers here, but I actually have updated your slides to bring you the 2021 update of the survey, where it looks at what do companies actually use. So you look between 1976 and 98. Now, accounting return dropped off the most. In 1976, 25% of all companies used accounting return as their primary decision group. It dropped down to less than 10% in 1998. NPV and IRR have climbed, but one of the strange phenomena was how payback has kind of hung in there as a way in which companies pick projects. In fact, it had a big jump in the 1980s. You know why that happened? 1980s was the advent of leveraged acquisitions, a lot of leverage deals. When you take on leverage to do a project, your first incentive is to get the cash flows to pay off the debt. You want front-ended cash flows, payback rose to the surface. Now, if I looked at when I looked at the 2021 survey, NPV and IRR have kind of stagnated now for the last 15 years. They're about 60% or 70% of companies use NPV and IRR. The number that's made the biggest comeback is accounting return in the form of return on invested capital. This is, as I said, it become this magic bullet in many consulting firms. You see it percolate into project analysis as well. I think it's extremely dangerous that it's come back. But that's the biggest thing that sticks out when you look at the 2021 survey numbers, is how return on invested capital is now being used in about 40% of companies in conjunction with NPV and IRR to pick projects. And you can think about what went into return on invested capital, how it gave you skewed decisions with both the iron ore mine and the theme park, and look at the consequences. But for better or worse, many of the businesses you're going to work with or work at, don't be surprised to see the CFO say, look, we're going to take this project because the return on invested capital on this project is much better than our cost of capital. Any questions on investment decision rules? So I'm going to stop there. Obviously, on Wednesday, we're going to do the case. So please turn in your case before 10:30. Right? So at 10:30, we're going to start here, and we'll talk about the case.
That's the measure that you are talking about. When you are saying like.
I don't like those words. What's an unlevered cash flow? What is an unlevered? Which one is the unlevered cash flow? Right.
Yes, you're referring to not to net cash flow, because net cash flow is like.
No, but when I did my Disney theme park, I was doing free cash flow. When I did Vale iron ore mine, I did free cash flow.
To change the rate that you are going to be.
Exactly. Yeah. Yeah, that's basically it. So I prefer the term free cash flow before free cash flow equity, because it forces me to think about, hey, the discount rate has to be a cost of equity when I do free cash. The problem with levered and unlevered cash flows is people then still are confused about what discount rate. No.
The potential buyer is no risk on the target, which
You still use the target, even though it's saving. You can't.
If finance all the day with the target, I don't think you're going to achieve the same rate.
But the target borrows against its assets and cash flows. Why would it be forced to borrow at a higher rate just because you acquired it, right? You borrow against projects, you borrow against assets. A bank is not going to change the rate at which it's going to lend money because of the fact that an acquiring company is a riskier company in a riskier business. Right? So I think that either way, the principle remains the same. Debt is trickier simply because if you have a target firm that has chosen not to borrow money because the management is conservative, you as the acquiring company might borrow money on its assets. It's not you borrowing money, and essentially lower its cost of capital. That might increase the value of the company, but it has nothing to do with it. The fact that the target company is
So we're kind of, so one is you had
because cash flow, you're looking at the target, and if you're able to lower your tax rate because you're selling market customers, you're going to basically have a lower tax rate in the marginal tax rate. No.
cost of debt, you always will choose the country where you borrow money because it's a joke. You don't have to spread your debt across the world. If you're selling your stuff in Ireland, purchasing that way, you can get debt because you want to get the maximum tax on that. So with debt, it's always at the margin. Interest safety tax is the margin, and you have a choice of where to borrow money. So use the margin tax. With cash flows, you can go with the effective tax rate because that's what you're paying on all of your income. This is not an amount of dollars, but all of your income.
Yeah.
The question you have to stop and ask is, why is my effective tax rate lower than marginal tax rate? It's because you're selling in countries with lower tax rates, that could persist, right? It's not, it's just not forever. Because it's really a weighted average marginal tax rate of the country you're selling. If it's lower because you're clever tax lawyers of deferring taxes, then you know what's going to happen eventually.
Yeah.
The tax rate is going to climb over time. So you might start the valuation with an effective tax rate.
Yeah.
But over time, you should probably move towards the marginal tax rate, especially when you get to the terminal year.
Yeah.
I'm going to give you a second shot. I said, do you want to leave it at the effective tax rate? But if you defer taxes, it's going to catch up with you.
If you had NOLs, for example.
Yes,
Absolutely, you built
yeah.
built up.
NOLs are easy, right? Because NOLs, you don't build into the tax rate. You just basically build into the cash flows, right? You basically take the years in which your profits, you claim the NOL against it, you save taxes in those years. I wouldn't mess with effective marginal tax rate. I just deal with the NOLs directly. The bigger problems is when you have tax deferrals that lower your effective tax rate for the moment, but they're going to go over. Then your effective tax rate can change over time and it'll converge on the marginal tax.
Okay.
That's why if you open the valuation spreadsheet I have, I let you start with an effective tax rate, but then I ask you, do you want me to move you towards the marginal tax rate by the time you get to your exam?
Yeah.
If you say, yes, I shift you. If not, I said, maybe you're just selling in lower tax rate myself, and this will persist, and I use the effective tax rate as is. But you can actually end up with two different tax rates in your valuation. An effective tax rate of 18%.
Yeah.
If you use the tax flows, and a marginal tax rate of 25%. That
Yeah.
That's actually what you really are getting. You're
Yeah.
getting the best of both worlds. You're getting the tax benefit, high from debt in the highest tax rate countries, but you're getting your income from all over the world in lower tax rate.
Whatever we decide, should we just be explicit or something?
On projects for cases, none of these reasons. I mean, if your reason is the effective tax rate for Tesla is low because it sells in foreign locales and this project is going to have foreign sales, specify it. But don't use the tax rate for your cost of debt. That you can't get.
We use the marginal, across, and then we were just thinking like, it probably doesn't make sense to use.
You could, yeah, you could probably get away with using effective tax rates, but it's probably not going to make or break the project.
Yeah. Okay.
So a couple of questions regarding the case. One is in the income statement, do we include the interest income that we will be generating for the cash?
What are you doing with the cash each year in the discounted cash flow? What are you doing with the cash each year in the discounted cash flow? When you discount the cash flow in year one, what do you implicitly assume?
That it's invested at weighted average.
It's gone.
Yeah.
You can't have a cash balance in the project and do a discounted cash flow valuation. The two are mutually exclusive.
Got it.
Okay, so if you want to use a zero cash flow in years 1, 2, 3, 4, and let the cash build up, then you might have a cash interest income. But if you're discounting cash flows and you let it happen, there is no cash balance, there's a zero cash balance. And that's perfectly okay. Projects don't have cash balance. Companies.
Got it. And the second question was with respect to the yeah, so for the new facility that we'll probably be acquiring in, let's say, year 4 or 5, do we capitalize that over 39 years, which kind of the use
Only reason matter is the depreciation will be affected.
yeah, so we can capitalize it up to like 39.
What's so nice about that? What's so special about
I
that?
just was reading online that the US tax law allows us to capitalize investment.
It doesn't happen, so that's a max.
Oh, that's.
You can't just pick 39 for any project, right?
Yeah.
It has to be a very specific type of project. My guess is well below 39. 39 is the absolute maximum depreciation
Yeah,
period,
that's
usually for land like investments.
So, what, like, how do we go about deciding what
Not
we
gonna make much of a difference. Waste too much time. 10, 20, whatever works, okay. And keep it straight line, it's easier to, keep it straight line depreciation,
Yeah.
otherwise
We calculate the NPV over 10 years.
it's a 10-year project.
Okay, so this is still just taking. Thank you so much.
Oh, you know what, actually, no. Because it's like operation.